The United States owes $39 trillion. That number is so large it has become meaningless to most people. So let me make it concrete. If you earned $1 per second, 24 hours a day, 7 days a week, it would take you 31,709 years to earn $1 trillion. To pay off $39 trillion at that rate would take 1.2 million years. The entire history of human civilization is only about 10,000 years. The debt is 120 times longer than all of recorded history. But here's what makes this number truly catastrophic. It's not the total debt that matters. It's the interest on that debt. At current interest rates, the US government pays approximately $1.8 trillion per year just in interest payments, not paying down the principal, just servicing the debt. To put that in perspective, the federal government collects about $4.7 trillion in total tax revenue annually. $1.8 trillion of that, nearly 40%, goes purely to interest payments. That leaves $2.9 trillion for everything else. Social Security, Medicare, defense, everything. And that $2.9 trillion isn't enough. The government spends about $6.5 trillion per year. Revenue is $4.7 trillion. The deficit, the gap, is $1.8 trillion to $2 trillion annually, which means the government has to borrow another $2 trillion every single year just to keep operating. And every dollar borrowed adds to the $39 trillion total, which increases the interest payments, which increases the deficit, which requires more borrowing. This is called a debt spiral. And once you're in it, there are only 5 ways out. Every one of them has happened before in history. Every one of them transfers wealth from one group to another, and every one of them destroys some portion of the population while enriching others. The US government will not pay back $39 trillion. That's not a prediction. That's mathematics. It's impossible. But what they will do is choose one of 5 mechanisms to resolve the debt. And that choice, which is being made right now behind closed doors by people you've never heard of, will determine whether you're financially destroyed over the next decade, or whether you're positioned to profit. In the next 25 minutes, I'm going to show you why the debt can never be repaid through conventional means using simple mathematics that a 5th grader could follow, the 5 historical mechanisms governments use when debt becomes unpayable, which groups win and which groups lose in each scenario, what the ultra-wealthy are doing right now that tells you which scenario they think is coming, and exactly what you need to hold to survive or profit from whichever path the government chooses. Because here's the truth that nobody in Washington will say plainly. The debt will be resolved, not through repayment, through default, inflation, confiscation, or monetary reset. One way or another, someone is going to lose trillions of dollars. The only question is whether it's you or someone else. Let me start by showing you why the debt can never be paid back through normal means. Because once you see the math, you understand why the government is trapped. The standard narrative says we just need to grow the economy faster, raise some taxes, cut some spending, and we can get the debt under control. This is a lie, not a political lie, a mathematical lie. Let me show you why. To pay off $39 trillion in debt, you need to run budget surpluses. A surplus means revenue exceeds spending. The extra money goes to paying down debt. So how large would the surplus need to be? If the US wanted to pay off $39 trillion over 30 years, like a mortgage, it would need to pay $1.3 trillion per year in principal, plus interest. At current rates, that's approximately $3 trillion per year in total debt payments. But remember, the government currently runs a $2 trillion deficit. To get to a $3 trillion surplus, the government would need to swing from $2 trillion to $3 trillion. That's a $5 trillion shift. The entire federal budget is $6.5 trillion. A $5 trillion shift means cutting spending by 77% or raising taxes by more than double. Neither is possible. If you cut spending by 77%, you'd eliminate Social Security, Medicare, and most of defense. There would be riots. The government would collapse. If you doubled taxes, you'd trigger the largest economic depression in history as consumer spending and business investment collapsed. Tax revenue would fall, not rise, because the economy would crater. So conventional repayment is mathematically impossible. But it gets worse, because the debt isn't static, it's growing. The government adds $2 trillion per year to the debt. So even if you somehow manage to pay down $1 trillion, you're adding $2 trillion. The debt grows by $1 trillion net. You're running backwards. This assumes interest rates stay at current levels. If rates rise, which they will if foreign buyers stop purchasing U.S. Treasuries, the interest payments increase. Every 1% increase in average interest rates adds approximately $390 billion per year to interest costs. If rates go from current levels to just 6%, which is historically normal, interest payments rise from $1.8 trillion to over $2.3 trillion. That's an additional $500 billion per year just in interest. The deficit would grow from $2 trillion to $2.5 trillion. The debt spiral accelerates. This is the trap. The debt can't be paid down because the deficit is too large. The deficit can't be closed because spending cuts or tax increases at the required scale would destroy the economy. And the problem gets worse every year as debt grows and interest compounds. So what actually happens? History gives us 5 answers. These are the only 5 ways governments have ever resolved unpayable debt in the last 2,000 years. One of these 5 will happen to the United States. The only question is which one and when. Option 1, outright default. This is the simplest and most honest option. The government announces, we owe $39 trillion, we cannot pay it, we are defaulting. Bondholders lose everything or receive pennies on the dollar in a restructuring. This has happened dozens of times in history. Argentina has defaulted 9 times, Greece defaulted in the modern era, Russia defaulted in 1998. When a government defaults, here's what happens. Bondholders, the people and institutions who own government bonds, lose most or all of their money. If you own $100,000 in U.S. Treasury bonds and the government defaults, you might receive $20,000 in a restructuring or zero. Foreign governments holding U.S. Treasuries, Japan holds over $1 trillion, China holds $760 billion, they lose trillions. The dollar collapses in value because nobody trusts U.S. government debt anymore. If the U.S. defaults, the dollar is no longer the safe haven currency. It's the currency of a deadbeat nation. Interest rates spike because the government has to offer much higher rates to convince anyone to lend to them again after default. If the U.S. defaults and then tries to borrow again, they might have to pay 10%, 15%, 20% interest instead of current 4% to 5%. The economy crashes because the financial system is built on U.S. Treasuries as the safest asset. Banks hold Treasuries as reserves. Pension funds hold Treasuries as safe assets. If Treasuries default, the entire financial system loses its foundation. Think of Treasuries as the ground floor of a 100-story building. If the ground floor collapses, everything above it collapses too. This is why outright default is unlikely for the United States, not because it's immoral or unfair, because it would destroy the global financial system that the U.S. benefits from. The dollar's reserve currency status, the ability to borrow cheaply, the entire architecture of American power rests on the perception that U.S. Treasuries are risk-free. Default destroys that perception permanently. So while default is the most honest option, it's the least likely for the U.S., but it's common for smaller countries without reserve currencies. Argentina, Greece, Russia, they defaulted because they had no other choice and the global consequences were containable. The U.S. defaulting would be a global cataclysm, so they'll choose a different option. One that achieves the same result, wiping out the debt, but through a mechanism that's less obvious and more politically palatable. Option 2, hyperinflation. This is default through currency destruction. The government doesn't refuse to pay the debt, they pay it in full, but they pay it in dollars that are worthless. Here's how it works. The government needs to pay $39 trillion in debt over time, but tax revenue isn't sufficient. So instead of defaulting, the Federal Reserve prints dollars. It creates new money and uses it to buy Treasury bonds directly from the Treasury. This is called debt monetization. The Treasury issues a bond. The Fed buys it with newly created dollars. The Treasury gets the money. The debt is paid. But here's the consequence. You've just created trillions of new dollars that didn't exist before. Those dollars enter the economy. More dollars chasing the same amount of goods and services means prices rise. This is inflation. If the Fed prints $10 trillion to pay off debt and the money supply increases by $10 trillion, prices roughly double. Your $100 grocery bill becomes $200. Your $50 tank of gas becomes $100. And most critically, if you're a bondholder expecting to be repaid $100,000, you get repaid $100,000. But those dollars now buy what $50,000 bought before. You've lost 50% in purchasing power. The government repaid the debt in full nominally. But they destroyed the value of the currency, which means they defaulted in real terms. This is exactly what happened in Weimar Germany. The government owed war reparations in gold marks. They couldn't pay in gold, so they printed paper marks. Between 1921 and 1923, they printed so many marks that the currency became worthless. A loaf of bread that cost 160 marks in 1922 cost 200 billion marks by late 1923. Hyperinflation. The debt was technically repaid in marks, but the marks were worthless. This was default by inflation. The same pattern played out in Zimbabwe, Venezuela, Argentina multiple times, Hungary after World War II. When governments can't pay debt, they print currency to pay it, destroying the currency's value. The U.S. could do this. The Federal Reserve can print unlimited dollars. There's no physical constraint. They could print $39 trillion tomorrow and pay off the entire debt. But the consequence would be the dollar losing 50% to 90% of its value, depending on how fast they printed. Hyperinflation punishes specific groups. Savers holding dollar bank accounts lose everything. Bondholders get repaid in worthless currency. Anyone on a fixed income, retirees, pensioners, they're destroyed because their income stays flat while prices skyrocket. But hyperinflation benefits other groups. Debtors with fixed-rate loans win because they repay in worthless currency. If you owe $500,000 on a mortgage at a fixed rate and inflation runs at 20% per year for 5 years, your mortgage becomes easy to pay off in devalued dollars. Asset owners win because stocks, real estate, gold, commodities all rise in price with inflation. Your house worth $500,000 becomes worth $2 million in nominal terms. The government wins because their $39 trillion debt becomes easy to pay in inflated dollars. So hyperinflation is a wealth transfer from savers and bondholders to debtors and asset owners. And the biggest debtor is the U.S. government. This is why hyperinflation is one of the more likely paths. It wipes out the debt without technically defaulting. It's politically easier to sell. We didn't default. We paid every penny we owed. Just in dollars worth 10% of what they used to be worth. But there's a problem with hyperinflation for the U.S. specifically. The dollar is the global reserve currency. If the U.S. hyperinflates the dollar, the rest of the world, which holds trillions in dollar reserves, gets destroyed. Foreign governments would revolt. They'd dump treasuries. They'd abandon the dollar. The U.S. would lose reserve currency status, which is the foundation of American power. So pure hyperinflation is also risky for the U.S. They'd be shooting themselves in the face to solve a debt problem. More likely is a slower, controlled inflation. Not 1,000% per year like Weimar, but 8% to 15% per year for a decade. Enough to erode the debt's real value by 50% to 70% while maintaining some semblance of dollar credibility. This is the path many analysts think is most likely. Inflate slowly. Destroy the debt over 10 to 15 years. Savers and bondholders still lose, but slowly enough that they don't revolt immediately. Option 3, financial repression. This is the sneakiest option and the one most people have never heard of. Financial repression is when the government uses laws and regulations to force citizens to fund the government at below market rates. Here's how it works. The government passes laws requiring banks, pension funds, and insurance companies to hold a certain percentage of their assets in government bonds. Banks are required to hold treasuries as reserves. Pension funds are required to have a minimum allocation to safe assets, which means treasuries. This creates captive demand. Even if treasuries yield 2% and inflation is 5%, these institutions have to buy them by law. They're losing 3% per year in real terms, but they have no choice. The government gets to borrow at artificially low rates because demand is legally mandated. This happened in the United States after World War II. The U.S. had massive debt from financing the war, over 100% of GDP. How did they pay it down? Not through surpluses, through financial repression. The government kept interest rates artificially low, below inflation, for decades. Treasury bonds yielded 2% to 3%. Inflation ran at 4% to 6%. Bondholders lost purchasing power every year. But the debt-to-GDP ratio fell from 106% in 1946 to 23% by 1974 because economic growth outpaced the debt and inflation eroded the debt's real value. This is financial repression, forcing savers to accept negative real returns on government bonds for decades. It's a slow-motion theft. You're legally required to hold an asset that loses value. The government benefits. You lose. And it's politically easy because most people don't understand real returns versus nominal returns. If your bond pays 3%, but inflation is 5%, you're losing 2% per year. But the statement says you earned 3%. It feels like a gain. It's actually a loss. Financial repression works through this confusion. The U.S. could do this again. Require banks to hold more treasuries. Require pension funds to hold minimum allocations. Keep interest rates below inflation. Over 20 to 30 years, the debt gets inflated away slowly without hyperinflation or default. The losers are savers, bondholders, and retirees who hold fixed income. The winners are the government and anyone who owns real assets instead of bonds. This is a likely path because it's quiet, legal, and slow enough that people don't revolt. Option 4, debt monetization with yield curve control. This is a more sophisticated version of hyperinflation. The Federal Reserve doesn't just print money to buy bonds. They actively control interest rates across the entire yield curve to keep borrowing costs low forever. Here's the mechanism. Normally, if the government borrows too much, bond yields rise because investors demand higher returns for increased risk. Higher yields mean higher interest costs for the government. The debt spiral accelerates. But what if the Fed simply refuses to let yields rise? What if they say, the 10-year Treasury will yield no more than 2%, and we'll print whatever money is necessary to buy bonds at that price? This is yield curve control. The Bank of Japan has done this for decades. They cap yields at artificially low levels and print money to enforce the cap. If bond prices fall and yields rise above the cap, the Bank of Japan buys unlimited quantities of bonds to push prices back up and yields back down. The result, the government can borrow unlimited amounts at low rates forever. But the cost is currency debasement. You're printing money to suppress yields. That money enters the economy. Inflation rises, the currency weakens. You've solved the debt problem by destroying the currency slowly. The US could implement yield curve control. The Fed could announce, we will cap the 10-year Treasury at 3%, period. If yields try to rise above 3%, we'll buy unlimited treasuries to keep them at 3%. This allows the government to keep borrowing at low rates even as the debt grows. But it requires printing potentially trillions of dollars per year to buy all the bonds that private investors won't buy at 3%. This is monetization. And it leads to inflation, but it's controlled, not hyperinflation. Just steady 6% to 10% inflation that erodes the debt over time. The winners and losers are the same as in hyperinflation. Savers and bondholders lose, asset owners and debtors win, but it's slower and more controlled. Option 5, gold revaluation and monetary reset. This is the nuclear option. And it's the one that sounds like conspiracy theory, but has happened multiple times in history. The US government owns approximately 8,100 tons of gold. On the government's balance sheet, this gold is valued at $42, 22 per ounce, a price set decades ago. At that price, the gold is worth about $11 billion. Meaningless against $39 trillion in debt. But what if the government revalued gold to its actual worth or higher? At current market prices around $2,700 per ounce, 8,100 tons is worth about $700 billion. Still not enough. But what if they revalued gold to $50,000 per ounce? Suddenly, 8,100 tons is worth $13 trillion. What if they revalued to $100,000 per ounce? That's $26 trillion. At $150,000 per ounce, it's $39 trillion, enough to theoretically back the entire debt. The government could announce, we are returning to a gold-backed currency. Every dollar is now backed by a certain amount of gold. And we're revaluing our gold reserves to appropriate levels to recapitalize the nation's balance sheet. This is exactly what FDR did in 1933. He confiscated private gold at $20.67 per ounce. Then he revalued gold to $35 per ounce, a 69% increase. The government's gold reserves increased in value by 69% overnight, improving the balance sheet. The US could do this again, but at a much larger scale. Revalue gold from $42 to $100,000 per ounce. The government's balance sheet is instantly recapitalized. The debt-to-asset ratio improves dramatically. Confidence in the dollar could be partially restored because it's backed by gold again. But here's the consequence. If gold goes to $100,000 per ounce, it means the dollar has been massively devalued because gold's price in dollars is really the dollar's value in gold. If gold goes from $2,700 to $100,000, the dollar has lost 97% of its value against gold. Everything priced in dollars becomes more expensive. Imports skyrocket in cost. The standard of living falls. And critically, anyone who held gold before the revaluation becomes enormously wealthy. If you owned 10 ounces of gold worth $27,000, it's now worth $1 million. You made a 37x return overnight. This is why central banks globally have been buying gold at record rates. China, Russia, India, Turkey, Poland, all accumulating thousands of tons. They're positioning for a potential monetary reset, where gold gets revalued and becomes the backing for a new currency system. If this happens, gold holders win massively, dollar holders get destroyed, and the government's debt becomes manageable because their gold assets now offset it. Now let me show you what the ultra-wealthy are doing right now, because their positioning tells you which scenario they think is most likely. Berkshire Hathaway, Warren Buffett's company, holds $189 billion in cash and treasury bills. This is a bet on deflation or financial repression. Cash wins if there's deflation. And short-term treasuries are safe in financial repression because you can roll them over as rates change. Bridgewater Associates, the world's largest hedge fund, has disclosed significant positions in inflation-protected securities and gold. This is a bet on inflation. Ray Dalio, the founder, has publicly stated he expects inflation and has recommended gold. Central banks globally have bought over 4,000 tons of gold in the last few years. This is positioning for monetary reset and gold revaluation. They're accumulating the asset that wins if gold becomes the backing for currency again. BlackRock and other asset managers are raising record amounts for distressed debt funds. This is positioning for defaults and bankruptcies. They expect deflation or financial crisis where companies and governments default and they can buy assets cheap. The pattern is clear. The wealthiest investors are hedging all scenarios. They're holding some cash for deflation, some gold for inflation, and monetary reset, some real assets for inflation, and raising capital to buy distressed assets if there's default and crisis. They win no matter which path the government chooses. The middle class, which is typically 100% in stocks through 401ks and 100% leveraged into homes with mortgages, is positioned for exactly one scenario: continued economic growth with moderate inflation. If any of the 5 options activate, default, hyperinflation, financial repression, debt monetization, or gold revaluation, the middle class gets destroyed. In default, their 401k stocks crash, their treasury bond funds lose value. In hyperinflation, their savings and fixed income lose purchasing power. In financial repression, their bond funds and savings accounts lose real value for decades. In debt monetization, same as hyperinflation, slow erosion. In gold revaluation, the dollar collapses, import prices skyrocket, standard of living falls. The middle class loses in 5 out of 5 scenarios. The wealthy, who are diversified across cash, gold, real assets, foreign currencies, and positioned to buy distressed assets, win or at least survive in all 5 scenarios. So what do you actually do? How do you position when the government has 5 options and all of them destroy some portion of the population? Here's the playbook based on what the wealthiest investors are doing. 1. Hold 20% to 30% in cash or short-term treasuries. This protects you if there's deflation or financial crisis. Cash gains purchasing power in deflation. And if there's a crash, you can buy assets cheap. But don't hold all cash because inflation destroys cash. 2. Hold 10% to 20% in physical gold. Not gold ETFs, not gold mining stocks. Physical gold coins or bars that you control. If there's a monetary reset in gold revaluation, this is your lottery ticket. Gold at $2,700 per ounce could go to $50,000 or $100,000 if revaluation happens. And even if it doesn't, gold holds value during inflation and currency collapse. 3. Hold 30% to 40% in real assets that produce income. Farmland, rental real estate, businesses that provide essentials. These survive inflation because they generate income that rises with prices. A rental property raises rents with inflation. A farm sells crops at inflated prices. Real assets maintain purchasing power when currency is debased. 4. Hold 10% to 20% in foreign currencies or assets: Swiss francs, Singapore dollars, Norwegian kroner. If the dollar collapses through any of the 5 mechanisms, foreign currencies that are better managed rise relative to the dollar. This diversifies your currency risk. 5. Own businesses or stocks in companies with pricing power, companies that can raise prices with inflation. Utilities, food producers, energy companies. These survive inflation because they pass costs to customers. Avoid companies with lots of debt if you think deflation is coming. 6. Eliminate variable rate debt. If you have credit card debt, home equity lines, or any variable rate loans, pay them off. In a crisis, rates could spike and destroy you. But keep fixed rate debt like a 30-year mortgage at 3%. That's good debt if inflation comes because you repay in devalued dollars. 7. Build skills that provide value in any currency environment. If the dollar collapses or there's financial crisis, your job might disappear. But if you have skills that are essential, medical, engineering, trades, you can earn income regardless of what happens to currency. And finally, 8. Prepare for standard of living decline. In 4 of the 5 scenarios, default, hyperinflation, debt monetization, gold revaluation, the American standard of living falls by 30% to 50%. Imports become unaffordable. Energy costs spike. Food becomes expensive. You need to be psychologically and financially prepared to live on less. The debt will be resolved. That's certain. $39 trillion cannot be repaid through normal means. The mathematics don't work. The government will choose default, hyperinflation, financial repression, debt monetization, or gold revaluation, or some combination. Each option transfers wealth from one group to another. In default, from bondholders to the government. In hyperinflation, from savers to asset owners and debtors. In financial repression, from bondholders to the government over decades. In debt monetization, from currency holders to asset owners. In gold revaluation, from dollar holders to gold holders. There is no scenario where everyone is fine. Someone loses trillions. The question is whether it's you or someone else. The ultra-wealthy are positioning for all 5 scenarios simultaneously. They hold cash, gold, real assets, foreign currencies, and capital to deploy in crisis. They win no matter what happens. The middle class, concentrated in dollar-denominated financial assets and leveraged into homes, loses in almost every scenario. This is not conspiracy. This is forensic analysis of mathematics and history. The debt cannot be repaid. It will be resolved through one of 5 mechanisms. All 5 have happened before. All 5 transfer wealth. And all five are being prepared for right now by people who understand that $39 trillion in debt is not a problem to be solved. It's a crisis to be exploited. If this showed you that the debt crisis isn't about economics, it's about wealth transfer, and you need to position before the transfer happens, subscribe. The next breakdown covers exactly which scenario is most likely based on current Federal Reserve policy, which assets win in each scenario, and the timeline for when the crisis becomes unavoidable. The debt is $39 trillion. It will never be repaid, but it will be resolved, and the resolution will make some people wealthy and destroy others. The only question is which side you're on.